There are 7 numbers that actually decide whether real estate or stocks will make you richer, and almost nobody runs a single one of them before choosing. Instead, most people run one number, the headline return, and that number on its own is close to useless. Today, I'm giving you all 7, the real math behind each, and the halfway mark reveal that explains exactly why the headline number lies to almost everyone who trusts it. My name is William. Here's the fact that should unsettle anyone who's ever heard real estate always wins. The S&P 500 has averaged roughly 10.4% a year, including dividends, since 1992, while U.S. residential real estate, measured the same honest way, price appreciation alone has averaged about 5.5%. Unleveraged, straight up, stocks have beaten housing by nearly double. The real estate wins story you've heard at every barbecue isn't describing the asset, it's describing something else entirely, and we're about to name it. Before the mechanics, the part that isn't a character flaw. If you've ever heard a friend's real estate success story and felt the pull to do exactly what they did, that pull wasn't foolishness, it's a very old cognitive habit. Humans generalize from vivid stories much faster than from averages, because a story about a specific person is memorable and a statistic is not. Nobody tells the barbecue story about the average outcome, they tell it about the one that worked. Here's who profits from you comparing the wrong numbers. Realtors earn a commission whether your net return after costs is 4% or 40%. Mortgage lenders earn interest whether leverage helps you or buries you. Financial advisors managing stock portfolios rarely mention real estate's advantages, and real estate coaches selling courses rarely mention stocks' advantages, because each is selling you the asset they profit from, not the number that would actually help you choose. Both sides of this argument have a sales team. Neither sales team runs your 7 numbers for you. Ines got the story secondhand at a barbecue, the way most real estate decisions start. A friend had bought a rental for $300,000 and sold it 6 years later for $450, a 50% gain. Told exactly like that, headline first. Ines had $100,000 sitting in savings and within a month put 20% down on a similar rental. She never ran a cash-on-cash calculation. She never priced in vacancy, a new roof, or what 6% in closing costs would take on the way out. 2 years later, after a bad tenant and an unexpected furnace, her actual return on the cash she'd put in was barely above what a savings account would have paid. Corbin, considering the identical kind of purchase that same spring, ran 7 numbers first, the ones you're about to get, before touching either asset. He ended up putting his $100,000 into a plain index fund instead, not because real estate is bad, but because his specific numbers on his specific property didn't clear the bar stocks were already clearing with no landlord required. Same starting amount, same season, 2 very different levels of homework. Here's the reveal, and it's the reason the barbecue story and the actual math almost never match. The number people run is the asset's raw return. The number that matters is the return on your actual cash after every real cost adjusted for the risk you actually carried. Those are frequently very different numbers, and the gap between them is where every bad real estate decision and every overconfident stock decision quietly happens. There are 7 of these real numbers. Here they are, each with the math behind it.
Number 1. The unleveraged return. This is the asset's raw performance with no mortgage involved. Stocks at roughly 4.1% annually, including dividends. Direct residential real estate at roughly 5.5%. On this number alone, stocks win clearly. Anyone claiming real estate just performs better is skipping straight past number 1. Number 2. Cash-on-cash return. This is where leverage enters, and it's the number that actually explains the barbecue stories. Put 20% down on a home appreciating at 5.5%, and the appreciation alone returns roughly 27% on your actual cash, because you're capturing gains on the full asset value while only your down payment is at risk. This is real, and it's the entire reason leveraged real estate can outperform an unleveraged stock position. It is also why real estate can lose far more dramatically than stocks when prices fall, because the same leverage runs in reverse. Number 3. Total round-trip transaction costs. Buying and selling real estate typically costs 6 to 10% of the property's value combined. Agent commissions, closing costs, transfer taxes, inspections. An index fund costs close to zero to buy or sell. On a $400,000 property, that's roughly $24,000 to $40,000 that has to be earned back in appreciation before you've made a single dollar of profit. Stocks start earning from day one. Real estate starts by climbing out of a hole. Number 4. Carrying costs. Property tax around 1 to 1.5% of value annually, insurance and maintenance running 1 to 2% a year, plus vacancy if it's a rental. On that same $400,000 property, that's routinely $8,000 to $14,000 a year leaving your pocket regardless of whether the asset gained value that year. An index fund's ongoing cost is its expense ratio, often a few dollars a year per $10,000 invested. This is the number Inez never ran, and it's the one that quietly ate her furnace and vacancy year. Number 5. Volatility, measured honestly. Commercial real estate prices swing roughly 1 8/10% quarter to quarter. The S&P 500 swings closer to 6 6/10%. Stocks are the rockier ride, and that roughness is precisely the trade you're being paid for in number 1's higher return. Smoother assets tend to compensate with lower average returns, and choppier ones tend to compensate with higher ones. Neither is free. You're choosing which discomfort you can actually tolerate. Number 6. The tax rules, which differ completely. Sell a primary residence and up to $250,000 of gain, $500,000 for a married couple, is excluded from tax entirely, one of the most generous provisions in the entire tax code. Investment property owners can defer gains through a 1031 exchange by rolling proceeds into another property, and can deduct depreciation against rental income along the way. Stocks held over a year are taxed at long-term capital gains rates, generally lower than income tax, with no exclusion of this size available. Both sides have real advantages here. They're just entirely different advantages, and most people compare zero of it before deciding. Number 7. Liquidity and what your capital gives up while it's tied up. An index fund can be sold and turned into cash within a day or two. A property typically takes 30 to 90 days to sell, sometimes longer, and that's after the 6 to 10% toll from number 3. The $100,000 sitting in a down payment isn't available for an emergency, a job change, or a better opportunity that shows up next year. That inflexibility is a real cost, even when nothing goes wrong.
Quick note on the channel before the pushback. This video exists because the industry answers which is better with marketing, not math, and running all 7 numbers takes about the same effort as reading one glossy brochure. If you want more comparisons built this way, subscribing is the vote for it. Here's my one request before the objections. Pick either real estate or a stock index right now in your head and run it through all 7 numbers this week. Post which number changed your mind, if any did. I read every one, and the honest answers are usually more interesting than the confident ones. The strongest pushback I'll get is control. Real estate lets you renovate, force appreciation, manage the thing yourself, and that's genuinely true. Call it an 8th factor sitting outside the 7 purely financial ones. Just know that control has a hidden price tag. Your own time becomes an input none of these 7 numbers ever counted, and a bad tenant can turn control into a second unpaid job for an entire season. Right behind that comes the margin question. Stocks can be leveraged too, so why isn't that in the 7? It can, and the math even rhymes with real estate. What doesn't rhyme is the clock. A margin call can arrive within days of a bad week, while a mortgage on an occupied property buys you months, sometimes years, before real trouble shows up. Same leverage, completely different amount of runway. And then there's rental income, which changes more than people expect.
A property that cash flows $200 a month on top of appreciation is a meaningfully different asset than one betting purely on the price chart. If that's your situation, don't skip it. Fold the actual monthly cash flow into number 2 before you compare anything else, because a flowing property and an appreciation-only property are not the same 7-number profile at all. If you recognized your own last big financial decision somewhere in those 7 numbers, a purchase made off one headline figure, a return you never actually verified, that recognition cost you nothing tonight, and it's the same gap Inez had before her furnace bill arrived. Here's what 10 years actually looks like once all 7 numbers are honestly run. $100,000 in an index fund at a defended 7%, no further contributions, crosses roughly $197,000 in a decade, taxed only on realized gains, sellable within 2 days at any point along the way. $100,000 as 20% down on a $500,000 rental, appreciating at 5.5% with typical carrying costs and 1 tenant turnover, nets out after the round-trip transaction cost, 10 years of carrying costs, and mortgage paydown credited back as equity, somewhere in a comparable range, sometimes ahead, sometimes behind, depending heavily on vacancy luck and repair timing. The honest finding isn't that one asset dominates, it's that the 2 paths land close enough that the 7 numbers, not the headline, are what actually decide which side of close you land on. Tonight, before you touch either asset, do 3 things. First, run your specific target, a specific property or a specific fund, through all 7 numbers, not the ones that flatter your preference. Second, name your genuine tolerance for number 5's volatility honestly, because the math can be perfect and still be the wrong choice if a normal down quarter would make you panic sell or panic list. Third, the piece this video deliberately leaves for its own sequel, the exact tax mechanics behind number 6, how a 1031 exchange actually works step by step, what depreciation recapture costs you later, and how the primary residence exclusion applies to edge cases like renting out a former home. That full breakdown is on this channel whenever you're ready.
One more piece belongs right here at the end, because it resolves a tension this whole video has been sitting inside without saying out loud. You don't actually have to choose between owning a physical property and owning a stock index. There's a third option that's been available the entire time, and it rarely gets mentioned in the real estate versus stocks argument because it doesn't fit neatly into either side's sales pitch. Real estate investment trusts, REITs, are companies that own and operate income-producing property. Apartment buildings, warehouses, shopping centers, sometimes hundreds of properties inside a single fund. Buy a broad REIT index fund and you own a slice of all of it, the same way an S&P fund gives you a slice of 500 companies. Historically, broad REIT indexes have averaged somewhere around 11.8% annually, meaningfully ahead of direct residential real estate's 5.5%, and close to or even slightly ahead of the S&P's 10.4%, because REITs capture rental income and commercial appreciation that a single house never touches. Run a REIT fund through the same 7 numbers, and something interesting happens. Transaction costs collapse to whatever your brokerage charges, often nothing. Carrying costs disappear entirely. No roof, no furnace, no vacancy, because professional management is already priced into the fund's small annual expense ratio, typically a few dollars a year per $10,000 invested. Liquidity matches any other stock. Sell in seconds, settle in a day or two. No 30 to 90-day waiting room. Concentration risk drops sharply, spread across dozens or hundreds of buildings instead of one roof and one tenant pool. Even the rental income question from a moment ago gets answered automatically, arriving as a regular dividend instead of a monthly landlord duty. It isn't a free lunch, and it shouldn't be sold as one. REIT dividends are typically taxed as ordinary income rather than at the lower rates most stock payouts enjoy, a real, specific cost number 6 never had room for.
And REITs trade on public markets, which means they can swing with stock market sentiment during a broad downturn far more than a house in a stable neighborhood usually does, even though the underlying buildings haven't changed a bit. You're trading direct control and geographic concentration for liquidity and diversification, and picking up a distinct tax quirk along the way, not eliminating trade-offs, just moving them somewhere else on the board. But if what actually drew you to real estate was the economics, the rental income, the property appreciation, a hedge sitting apart from your stock portfolio, rather than the specific experience of owning a physical building and managing tenants yourself, a REIT index fund deserves a serious look before you sign anything at a closing table. It's the one option on this entire board that lets you run all 7 numbers and come out ahead on nearly every single one at once, at the cost of never once being able to walk through the property yourself. 2 accounts sit open tonight, one property listing and one brokerage tab, and somewhere between them is $100,000 that hasn't decided yet. Ines already knows what happens when only the headline number gets checked. Corbin knows what happens when all 7 do. Not a guaranteed winner, but a decision he can actually defend a decade from now, on numbers instead of a story he heard at someone else's barbecue. Real estate and stocks were never really competing against each other. They were both competing against the version of you that only ran one number and called it math.